All right, guys, welcome back to another episode of The Deep End. This is big number 14. And right before we went live, Ari and I were just talking about our portfolios for the day. It's so funny. I think we kind of jinxed it because I don't know if Ari, you checked yours quite yet. I checked mine this morning, and obviously, it was down in the red. Um, but we were going to kick this off with a little portfolio update, expecting things to be pretty sour as they have been all week. But lo and behold, went and looked at the portfolio for the day, and to our surprise, it was not red at all. From this morning, things I don't know exactly what happened yet. I'm pulling up some news as we're talking right now, but it seems like the market's done a total 180 just in the last couple of hours. And just for some context, I think I was down maybe about 1% or so this morning as the market opened, and it's Wednesday, April 9th as we're recording this, so the day before this portfolio or before this video's and this episode is going out. I think I was down about 1%. And real quick, guys, across my entire portfolio, I'm up now 5%. So in the taxable account, I'm up 4.8. In the Roth IRA, I'm up 5.6%. And the S&P just today is up 7.65%, with SCHD up 5.35%. So like I said, things just did a total 180. Ari, I want to throw it over to you. How are you today? I'm curious to know how much you're up, because it's probably going to be pretty aggressive, much more than mine, I would guess.
So I got a question for you. That was all just the one day, right? Today? Your returns
Dude,
for today?
yes, that is so far today. And the market's still open as we're speaking. And yeah, across my two portfolios just for today, I'm up about 5%.
So first of all, I'm looking on Blossom, just trying to find real quick where I am. And I'll back up and just say I didn't even look. The market opened. I didn't look at my portfolio. I haven't been looking at anything. And I've honestly, when I open up Vanguard, the only thing I'm there to do is buy. I don't even look at the numbers, but I got the 5-day and the year-to-date metrics that I'll share because that's what I can see right now, and I don't want to waste anybody's time. 5-day, at least in terms of the returns, I mean, we're actually down 7.2%. Year-to-date, we're down 19.2%, and so it's a hefty sum. But again, everybody out there knows kind of my strategy and what I've been up to, which is heavy concentration. More of a focus on the growth stocks, dividend growth stocks. And that means that when there's big market swings, I mean, I really take a hit. I don't even want to say I take a hit. I take an opportunity, if you will, because the only thing that happens is I'm buying. But what I will say, look, there's inflationary data that came out pretty strong today, and that's what it seems that the market is reacting to, at least right now. We also had a couple other things that happened today that were pretty, I think, surprising that I actually wanted to talk to you, Ryne, about and catch your opinion on it. The first of which is actually President Trump tweeting that it's basically like a buyer's market and it's time to buy. Now, the moment he tweeted that, the market actually flipped from red to green. And
Oh, okay.
that was hours ago. I want to catch your opinion on I mean, I feel like that's a storm and a half brewing. I don't think any president should get involved in stock advice, if you will, or stock suggestion. And then I saw this tweet, and of course the markets went green, and that literally moments after. But what's your take? I just don't think a president should be involved in that capacity at all. And I know we're not dealing with the typical president in the White House who's going to refrain from making tweets and remarks like that. But I almost think it's a pretty dangerous thing for him to share, any president to share, because you're touching the masses of people who really don't have, I want to say, the best emotional control. And you're telling people to buy. What exactly are they buying? How are they buying it? And are they going to sell when we're still in the midst of this volatility? It could be very scary.
Yeah, it's tough because I don't necessarily disagree with him on that. That's a message that I think we've shared multiple times through all this, and it's true. I mean, kind of like, even you were saying just a few minutes ago, now is much better opportunity to buy than it was I guess, at the start of the year. So from that point of view, he's right. Whether or not he should be speaking on those things, I don't know. I don't know that I have a real serious opinion on that. But yeah, I don't know that I have a real serious opinion on it either way. Um, I don't know. I guess I don't have much more to say on the subject beyond that. But actually, no, I do. Excuse me. Another thing I wanted to say on that was, it just depends. Like if things go lower from here, which they very well could, then yeah, it turns out it wouldn't exactly have been a good time to buy. But as those of us who spend time in this stuff know, it's like, okay, well, that's why dollar cost averaging is such a handy tool, because you can continue to take advantage of these continued dips without completely blowing your wad at the first sign of weakness. Um, so I don't know. I guess all of that's to say I've kind of a mixed sentiment on it. Um, One of the reasons it looks like, in addition, I didn't know about the tweet that you referenced earlier, but one other thing it looks like, and maybe this was more so a cause of the turnaround today, was that there was a 90-day pause issued on reciprocal tariffs. I'm reading the news from Seeking Alpha right now. A 90-day pause on reciprocal tariffs for all countries except for China. So I'm guessing that had a lot to do with the pop today. So, which we'll see what happens from here. I mean, this just kind of furthers the volatility, and we'll see what happens 90 days from now. Maybe this means that we're in for more volatility over the course of these next 90 days. Maybe it just continues to extend that. But I don't know. I don't know. I'm going to leave it there because I could keep rambling.
Look, it's certainly interesting, and I want to go back to even just Trump's tweet. I agree with him and with you that the time is now to buy, and I just asked myself like a deeper question of when you're touching. It's like me and you. We're out here, whether it's the deep end or our own channels, and I know we both remain pretty cognizant of like what we say and how we say it to make sure that nothing gets misconstrued, or at least when we say something like the time to buy is now, it's almost like a comma there after that instead of a period, because there's more to say. Well, what is there to buy? What's the investor profile? There's a whole bunch of questions. I don't know. I just saw the tweet and the market flip green, and I go, oh my goodness, are we going to get a lot of individuals who aren't necessarily prepared to handle the market volatility in this type of market environment? That's kind of where that fiduciary responsibility, YouTubers' fiduciary responsibility kicked in, at least for me. And looking ahead, speaking of a 90-day pause, that just means, in my opinion, we're going to revisit this in 90 days, and we could very well get more volatility. But as we always say, which is nice, is that investor who's out there on the younger end, with decades to go. And again, I mean younger with, if you're in your 20s, your 30s, even your 40s, that does leave you with some decades to go before you're actually out in the retirement pasture, which means that will be, another day of opportunity for you to actually jump in, build up these high quality positions and sit pretty for the longer term. And if you are right now, I mean, wow, there's so much, even I want to talk about with like Apple and whatnot. But if you're an older investor right now, just about to enter retirement, my hat's off to you, because it's certainly not, I know right now for me, I'm like having a heyday, but I can easily look at somebody else's, position and just be like, wow, if you're 64 or 65 right now, just be very cautious out there. And on the other end, something I was thinking about all day today, Ryne, Apple is one of my largest positions. Big update on my portfolio based on how everything's been going. Alphabet, Google actually just took the largest holding in my portfolio at this point in time, replacing Apple as the largest position. But nonetheless, these two go head to head in my portfolio. And I just couldn't stop thinking about Tim Cook today. I was almost like, it's like the U.S. and China got married and then got divorced, and Tim Cook's the only child. And it's like, how do you think Tim Cook is feeling with these tariffs and just everything that's going on? And I know Apple now has their plans, which is not new. This has been in the works. I was thinking about it even earlier today. Months ago, we saw Tim Cook visiting India and making strategic plans to move a lot of assets of Apple's over to India. So this was really, in my book, just all in the strategic plans long ago. But we're really seeing now today how all of this is playing out. And it's just, I would wonder what's going on in Tim Cook's mind, and how he's handling the day, because whether it was yesterday, today, or when people are viewing this tomorrow, you got to be sweating it out.
Yeah, and unfortunately for him, to a degree, his hands are kind of tied. What happens between the U.S. and China is completely out of his control. So all he can do is continue to, I don't know, diversify where Apple's products are being made. And if that's something that's already been in the works, then it's kind of just keep on keeping on. But in the meantime, until those plans really do come to fruition, yeah, he's definitely in a tough spot.
Just imagine him just sweating it out. It's like,
Yeah.
what do you do, man?
Well, fortunately,
crazy.
like Apple can afford to withstand some turbulent times. They've got so much cash, so much liquidity, so much flexibility working in their favor, and I think that just speaks to the importance of owning companies with balance sheets that are kind of along those lines, where that no matter what's going to happen, they'll be able to persevere through it and make it through to the other side without going bankrupt or without having to take on a whole lot of debt, because they've got the means to support themselves through this difficult time.
Yeah, spot on. Spot on.
It's kind of funny that you bring up Apple though, because I was talking to my mom yesterday, and she asked me what what I think about all this crazy stuff going on right now. And I told her things that are along the same lines that you and I talk about pretty frequently, things that I talk about on my channel. And I just kind of gave her the whole rundown. I told her, it's probably a better time to buy. I did throw that to her. I told her that a lot of what we're seeing is, at least here in the short term, is kind of an emotional response to this news. And I, tried to reiterate from a long-term perspective, things are going to be just fine. But I was thinking about Apple because she has a pretty decent Apple position in her IRA, I think, in her retirement account, and she's had it for a while. And my mom's not a super big investor. She has a financial advisor that makes those decisions for her. But yeah, she's had this Apple position for quite some time, and it's one of her larger holdings, and she's done really well on it. Like, I think her cost basis is somewhere just below $100 per share. But I was thinking, like, okay, what's the right move? Like, because my mom just turned 60, she'll be retiring here relatively soon in the next couple of years. So I started to think, man, what does this mean for like someone in her shoes? Is it, considering what's going on right now and how fast things can change in the market, is it worth maybe starting to transition into some higher yielding positions? And as I've kind of gotten deeper and deeper into, what I'm doing with all of this stuff, she's gotten to learn about other stocks like Realty Income and whatnot. And so she has some Realty Income in her portfolio too. But I was wondering, is now, maybe not now after things have already dropped, but would it be a good time, like when we do see a recovery, would it be a good time to start making that transition into things that are a bit higher yielding, maybe where the returns are less dependent on the share price as she enters this next stage of her life? Because I could hear it in her voice. She was kind of feeling concerned about what was going on. Maybe not entirely just from, just worried about her portfolio, but just the economy as a whole. And so I was wondering, man, I guess what would be the right way for her to approach this entire situation? Because it's easy, kind of like you were alluding to, it's easy for people like yourself and myself who have so much time left until we, are going to be using our investments. We can afford to just sit through all of this stuff and feel pretty comfy cozy, but that's not necessarily true for everyone else. So, and while I think that the investment strategy is more or less the same, at the end of the day, you do want to invest in high quality businesses that are growing, which Apple is. At the same time, there's another component to it where it's like, realistically, you want to get the most out of these investments that you can. So what does that look like? What does that look like for her? And it's something I've been thinking about, and I don't quite know the answer as it pertains to certain stocks like Apple. You know what I mean?
100%. Look, that's why I was sharing just a moment ago, right? I'm happy to be where I'm at in life in terms of being 30 years old and having, 3+ decades to go. But again, going back to someone who's nearing retirement, maybe 5 years or less to go, or in your mother's case, only a few years, you really got to start to play chess and really with each move be strategical and really think about what you're doing. Even if you're just invested into the S&P itself, when are you going to pull the money? How are you moving money? Everything becomes, in my opinion, more of a game of chess, which means you got to look to the best that you can 20 steps ahead, which, as we know, as investors, is nearly impossible when it comes to this game of investing. But you have to do your best because, you do have to question to some extent that there are people out there that, whether it's the Stanley Druckenmillers, Warren Buffett's, Mungers, that really can sit down and look at the bigger picture and play the game of chess well, at least when it comes to the market. And that's where I think that you can't make any drastic decisions, and definitely you can't be making emotional decisions. When it comes to a play like Apple, and there's also so much more to it because specific to Apple, I've been posting about Apple, whether it's been on Twitter or on Blossom, and I've been posting about Apple because it's a large position in my portfolio. I mean, a lot of people are giving, some kickback, just saying, "Oh, Apple's dead anyways." Like they're only producing iPhones. Now, I have a bullish opinion on Apple, but the reality is, it's like that's something to maybe factor in a little bit. How do you think, Apple's future is going to look in 5 years, in 10 years? And right now, I mean, if you were to sell out of Apple, I think you would be missing out. Let's just say it's your mother's case. You'd be missing out on upside that I believe is around the corner. And now I do believe that's going to take a little bit of time. And that can be, about a year's time for I think a real full recovery and launch, I want to say. Or it could be, again, we just saw today, moments ago, right? Like the stock market skyrockets because we got a delay in tariffs. Now, all countries except for China, which means Apple's moving essentially everything over to India, where we're going to see this great shift. And so what does that look like? But either way, you must take your emotions out of it and ask yourself the question of where do I see this company in, at least if you're nearing retirement, 2 to 3 years? And if you're younger, where do I see this company in the next 2 to 3 decades? If you can kind of think about on that scale. I know it's hard, but I don't personally foresee Apple disappearing. And someone compared Apple to Nokia earlier today. And, this individual was like, I worked at Nokia for 5 years. I saw the writing on the walls. And, hindsight's 20/20. I'm going to say that. But also, I think Nokia and Apple are different. And I think the Mag 7 players today are different from the Kodaks of the world. And I know this sounds, probably like an investor back in the day who was heavily invested in Kodak or Nokia saying, well, these companies are different. But we haven't had companies valued at these valuations, insane market caps, almost global domination with Apple, right? We just haven't had these companies. And I like to think that actually a part of Apple's strategy is not producing some crazy new phone for predictability purposes. Consumers like predictability to some extent. And so that's why we keep buying the next iPhone, even though it's only the most minute changes. We like holding these little flat screens in our hand We like them faster, maybe a little thinner, but then we like them a little thicker because then, the next year, the next model comes out, it's like a little bigger, whatever it is. We like, though, that predictability. And we like what Apple's delivering. And I think what Apple's really working on at this point in time, just like every other Mag 7 player out there, is the integration of AI and quantum computing. Now, what does that look like on an iPhone? That's going to deliver, I think, the next generation. So while everyone's so concerned about hardware, I start to take a look at the software, right? And like, what are the integrations going to be? Like, how are we actually going to use these devices? And I think Apple's got a long life left ahead of it. Therefore, I think anybody nearing retirement and holding Apple right now would probably be better off at least not panicking and holding on another 6 months to a year, if you can.
Yeah, I think that sounds reasonable. I think it's easier to, I guess what I was trying to say a few moments ago was it's easier to predict maybe what the business of Apple is going to look like in the next few years or couple years, but it's more difficult to predict what the share price is going to look like. And someone in my mom's shoes, that's probably that's the important part, right? Like if you're entering a stage where you're going to be using these investments to pay bills, it can obviously be concerning if a lot of what you're relying on is the share price moving a certain direction. So that's kind of the context from which I was thinking about it. But yeah, going back to Apple, I think you're right. It still seems like, okay, so at some point I think that there's going to be a next thing. There's going to be a next iPhone, a next revolutionary way that we communicate. I don't know. It's just as far as the hardware goes. I don't know if it's going to be something similar to this or something totally different. I think that's the big question mark. Whatever it is, it'll come at some point, and it still seems like we are quite a ways out from that. And in the meantime, it's just going to continue being the iPhone. So to your point, it's like there's still quite a long runway for this thing. And kind of the in-between does seem like there will be more implementation with ChatGPT. And I don't know, do you or not ChatGPT specifically, but AI in general, but specifically ChatGPT, do you use anything like that? Have you messed around with any of that stuff all that much?
I'm a big writer. I love to write. And so therefore, as a creative, I like my original thought, but it depends what I'm doing or what I'm writing. And how one uses ChatGPT, I think, changes the game. Because if I'm doing something that, maybe I need to make something, more professional, or maybe I need a new idea, and I just you can type anything into ChatGPT. Like I'm thinking about, I don't know, a podcast name. Give me 10 names that deal in the realm of finance, right? And it, boop, 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 boop. Not that we figured out the Deep End's name this way, but you get ideas. And so I think that there are unique ways to use ChatGPT, and tying ChatGPT and all this into kind of one, this is where it's all leading. Imagine your iPhone just doing things that it's going to save you time, energy, right? It already does just that. But these types of integrations are just going to be easier.
Mm-hmm.
And that's really where I think everything's heading.
Yeah, absolutely. So with ChatGPT, one of the big new things that I've seen them implement recently is you can actually talk to it now, and it will talk back to you. This is probably at least a couple months or a few months old at this point. So for a lot of you guys, this is probably not new news. But in case it is, yeah, you can actually talk to ChatGPT. You can do it on your phone, you can do it on your computer, wherever you're using it. And I've got to say, I've been doing that more lately, just chatting with it instead of typing stuff out, just talking to it. And I just think that's going to be one of the big use cases for it, I think, or one of the big ways that we use it moving forward. And I think tying that back to Apple, I think that's kind of what Siri was supposed to be, right? Like it's supposed to be this assistant that helps you do stuff with your phone. You can talk to it. But I don't know about you. I've never really had a great experience with Siri. It's always been kind of wonky to me. It's never worked quite like how it should. And I feel like ChatGPT is talking to it as a much better version of what you've gotten with Siri. So I'm wondering if there's going to be some sort of connection or some sort of more seamless integration between the two in future from future iPhones or for future iPhones. I don't know. That's kind of one thing I'm thinking about with that.
Look, the landscape is so competitive now. Every one of these companies came out with a new chip.
Yeah.
You know, like they do one thing and everybody else has got to do it. The rest of the mags are like, we're in on it. We built our own, or we're building our own, or, you know, and so it's like Amazon's got Alexa, you know, Apple's had Siri. Everybody had their thing. But, you know, what's also interesting about this, I think all of these companies have to stay in their zone. And this is just back to the fundamentals of building a business that's going to be successful. I think a lot of these companies, you know, and don't get me wrong, like I love Amazon and Jeff Bezos, and I love reading. I read like all books on Bezos, and obviously Amazon invested literally billions of dollars into new ideas. Hundreds and hundreds and hundreds of these ideas failed. You know, then you have like the 5 to 7 that took off and made Amazon, everything that we have from Amazon today. But, you know, what's so important is not, I think, to go too outside the box, because just to go back to someone else commented on a post I had today about Apple, and they were like, you know, Apple's dying because they had the VR headset and now I don't hear any talk about the VR headset. And I'm like, you know, as cool as that is, right? It's like Apple's got the Apple Watch, but we're not still necessarily like, oh, Apple, the Apple Watch. No, Apple, the Apple iPhone. And so it's like, go back to your primary before you get to the secondary, so on and so forth. That's your core, you know, building block, and everything else, you know, you can let fall by the wayside if it's not necessarily taking off. Amazon did the same thing. Right? It just so Alexa, by the way, was not even supposed to be Alexa. Alexa actually was something that came about after Amazon tried to create a mobile phone and it failed. But all of a sudden they had this talking feature and it became Alexa. Like, that's how that happened. So I think people have, you know, just they just get rattled by emotions, I think. You know, something fails, they go, oh, the whole company's a failure. Not true. Right. And then I guarantee you, if I ask that individual, well, are you using an iPhone? You know, it's like, yeah. It's, are you going to buy the next one? Probably. Right. So I think about that. And I just think all of these companies, the Mag 7 in particular, they're going to remain highly competitive. I don't see them going anywhere, at least anytime soon. I'm not here to say that they're going to be here for the next century. I don't know what the next century looks like. But I think for the foreseeable decades, for sure, they're going to be here. And, you know, innovating as they are right now, driving the AI and quantum computing revolution and driving us into a more technologically advanced future, which is crazy to even say that because we're pretty technologically advanced now. I don't know what, you know, the next year, 2, 3 brings. No one could have, I don't think, saw NVIDIA coming 5 years ago, 6 years ago.
Yeah, those are such great points, man. And I completely agree. It goes back to, I haven't read this book, but it was from, I think it was one of the former CEOs of Intel. He wrote it. The book was called Andrew Grove, I think was his name. Only the Paranoid Survive. And that definitely applies to a lot of these big tech stocks. I mean, with Intel, actually, you see what happens when you get complacent and you don't try new things or continue innovating. And you know, obviously, a lot of these big tech companies, they know that, and they know how fast things change. So there's no time to become complacent, because that's how you end up becoming extinct, essentially. And so, yeah, it's good that they're trying these different things. And this also goes back to the importance of having like the financial profile that they do, just being cash printing machines and having so much cash. You know, they can afford to try and test out these different projects and basically just throw things at the wall. Kinda. It's not as random, I'm sure, but you know, try different things to see what sticks. And the good thing is there's not much downside to doing so, because if it works, then it's going to work big. But if it doesn't, then they really haven't lost that much. And it reminds me of that classic Monish Pabrai quote or way of doing things. Like, he chooses his investments based on the idea that heads I win, tails I don't lose too much. So all of that's to say there's really not too much risk for these businesses in trying these different things, whether or not they work out. Because if they spend some money to create the Apple Vision or whatever it was called and it doesn't work out, that's fine. It's just some cash that they spent and a little bit of time, and they've got plenty of cash and an infinite amount of time to try the next thing. So they've put themselves in a really good position to be able to afford to take these risks, which at the end of the day really aren't that big. And it's easy to get down on these companies for trying something that doesn't end up working out. But it's like, if you think about your portfolio, have you gotten every single investment right? I doubt it. And we can't expect these businesses or really anyone else to do the same, because at the end of the day, it's, we're all just human beings and we're bound to make mistakes.
Look, it's the guy who shows up to the bar, the friendship circle, whatever, after a football game, and then he's looking back at the game. Oh, if I was a QB, I would have done this. It's like, nah, you wouldn't have, right? You probably would have thrown the ball way worse than the QB, made terrible decisions, and lost the game by way much. It's just that type of thinking, and you got to think
the man in the arena.
These people. Yeah, exactly. That's exactly what it is.
Mm-hmm.
Ron, I got a question for you though. Let's say, and I think this is gonna be a little crazy for you. I don't want to make you too anxiety ridden, man.
I'm nervous.
Let's just say you had to take your entire portfolio and dump all your capital into just one of the Mag 7s.
Oh, that's a really good question.
You had the next couple of minutes to do it. What stock? Which Mag 7 would you pick, and why?
So first, the Mag 7, just so I understand it, we've got Nvidia, Apple, Microsoft, Google. What am I missing? Tesla. What are the other two? I'm missing two.
You get Amazon in there?
No, Amazon, and then one more.
Man, what did we name?
I don't know. So let's start narrowing it down from here, though. We've got 6. So Tesla, no. Nvidia, probably not. Apple, I don't think so. So out of the remaining, it's kind of funny. Here, let me
Microsoft,
jump hands. Yeah. Out of the, Microsoft, I think, was on that. We already mentioned that one, I think. Out of the remaining, it would be Microsoft, Google. Well, honestly, it would probably be between those two. And if I had to choose,
you have it, Apple, Microsoft, Amazon, Google, Tesla, Meta. Meta's what
Meta. Okay.
Now talk about a company that I would not touch, personally.
Yeah, it's tough. I mean, you could make the argument that Meta is like one of the most. You could make the argument that it is a sin stock and it is the most addictive out of the bunch. You could certainly make that case. But man, I'd probably have to go with Google. I think that I'm probably a little bit biased. I mean, they certainly send me a paycheck every week, and us now, just here on the channel, on the deep end. So, I certainly want to see that company do well. If Google does well, I'm hopefully doing well. So I probably would throw it into Google. They are very diversified, not just search, not just YouTube, but cloud and all the other stuff that they're working on, quantum computing, AI as well. So there's just a lot going on under the hood, and I'm sure I'm leaving out so much of what they do. But I would feel the most comfortable putting it into Apple, or Google, excuse me. And that's not to say that I wouldn't feel comfortable putting it into Microsoft or Apple or even Meta. But Google is the one that stands out the most to me. What about you? Would you say Apple, or would you pick a different
that's
one?
Not to say I wouldn't feel comfortable, then you just listed the rest of the Mag 7.
Yeah. Well, that's true. It's not to say, obviously, that none of them are bad businesses. None of them are. But if I had to just pick one, I probably would go with Alphabet.
I'm right there with you. Matter of fact, literally my money is where my mouth is. Apple just fell number 2 in my portfolio, at least in terms of individual holdings, and Alphabet just took number 1. I was reading some things today and yesterday and throughout the week, and We talked about this weeks ago, and you were the one who brought this up in the first place, but you were like, I feel like at some point or another, you might even get more concentrated. And I was like, I don't know, maybe 7 to 10 holdings. That's what I'm at. And yeah, Ryan, I mean, over the last few days, I'm thinking about getting more concentrated.
Oh, no.
It's no joke. I mean, I'm really, just thinking about it all day, mulling in on it. And the reason being is actually, and this quote comes from George Soros, but he was talking about essentially, he said, put all your eggs in one basket and watch the hell out of that basket, right? And some of these guys, I mean, look, I just reached out to a hedge fund manager about 45 minutes ago, and I had asked him for his opinion on some of the things I want to do, because I don't think I'm that crazy. And am I riskier? Yeah, but you know what? I think about the guys like George Soros, and I think about the Bill Ackman. I just think about all of these guys who, like, yeah, a little crazy, right? They're going to bet really big. But also the way I structured my portfolio, which I do want to wrap back to kind of your mother's position and other people nearing retirement, because the way I structured my portfolio allows me to take bigger risks when it comes to individual stocks. Over 50% of my portfolio is, a balanced mix of 2 ETFs. So when I go and say I'm going to take this big risk, it's like, well, are you really taking this big all-in type of risk? No, but when it comes to your individual stocks, you'll have like, your 7 of them. But now I want to narrow that down. I'm like, it's not really a great risk. I have a massive position in the S&P 500. That's my foundation. I built that foundation up so that I can invest big in individual stocks. And then I built a tech ETF out. And I built that position out so that I can go bigger on certain individual stocks. And so now, what I'm thinking about doing, and this is, I guess, the biggest update that I'm probably going to pull through on it, because I always, will say something here and then I do it pretty quickly. Usually when I say something on the deep end, it's because I've already thought about it for a long while, and it's just like the last couple of, I don't know, hours maybe before I pull execution triggers. But, I'm looking at Visa, Ryne, and Visa is a phenomenal company. But another one might bite the dust, man. What can I say?
Wow.
And you know where I'm putting it? Right where I'm, putting all the money in Alphabet. Because I really do believe, and I have very high conviction in Alphabet. An insane amount of their revenue continues to pour in from advertising. I think advertising over the next decade is going to get insane. It already is. But you just think about Google's market share, and then YouTube, the largest search platforms in the world, all under Alphabet. And no other search platform even comes close, Ryan. Then we sprinkle in the phone and the apps and all the other little sprinkles of their revenue. And I just think that's crazy. And I don't, I look at their balance sheet. I mean, I don't think I've seen, he's here?
Here he is. It's just in time.
He's coming to talk about stocks in this decision I'm about to make.
He wants to tell you about his portfolio, tell you about his dividends.
Oh yeah, I was gonna say like kibidins.
Yeah, there you go.
Yeah. But I don't think I've seen a cleaner balance sheet on the market. I always try to think, is there anyone that comes close to Google's balance sheet in terms of cleanliness or health rather?
Yeah, I mean, it's tough to find something more pristine than them. I'm guessing, I haven't looked at it super recently, but from my recollection, they have a negative net debt position, right?
Yeah.
Yeah, I mean, what's not to love about that?
You can't like. I can't. First of all, I don't know why. I know Buffett's it was, and still is heavily invested in like Apple, but I look at Google and I'm like, this is this is a balance sheet that I love.
Yeah.
You know, like you can't even get close to a balance sheet like that. And if anybody out there listening has a company with a cleaner balance sheet in mind, drop the name of the company in the comments, because I'm been thinking about this for a while, and I'm insanely curious to know if anyone's found anything remotely as clean and as healthy as Alphabet's.
Yeah, I mean, like I said, man, you can do no wrong with a negative net debt position. That's always one of my favorite things to see when looking at a company. So, and not, some of those opportunities are few and far between, especially outside of the tech space. But love to see it when you can find it.
It's just, look, it's going to be the George Soros approach, I think, to this whole thing. I mean, it's Bill Ack, it's all of these guys. They're all in my head.
Yeah.
But the other thing is this, Ryne. I've just already seen tremendous success with what I've been doing, and again, bigger risk, definitely. And I don't recommend doing what I'm doing to anybody out there, unless you're really able to sit calmly in volatility, and like you really are taking a look at what's happening in the market and in the world and how people are reacting. Because being down $30,000 plus, earlier this week, I didn't flinch, because I understand it's like the long game, right? And it's like, okay. And I know what I'm invested in. I know the risk, before I got involved in this. But for someone who's not, quite experienced as an investor, really sitting in volatility, I think I would have sold, or I think I would have got flighty and got really nervous and made some decisions that probably weren't going to be so good for me long term. So that's why I say, like, I wouldn't recommend it to anybody, but for me, like, I'm in, man. I'm putting all my eggs in one basket. I'm gonna watch the hell out of the basket.
Yeah, I think obviously you've set yourself up in a position where you can afford to have less individual holdings. Having those two ETFs as half or more of your overall portfolio definitely gives you that safety net that you would otherwise find from having a wider selection of individual holdings in your portfolio. So I definitely think you can get away with consolidating even more if you want to. So, I mean, at this point in time, with Visa, you have 7 total holdings. That would be 2 ETFs and 5 stocks. Am I counting that
No,
right?
right now I have nine
Okay.
total holdings. Yeah.
Okay. So 7
And
individual companies.
yeah.
Okay. Yeah, man, you got some room. You got some room to keep going if you want to. And
You
kind
know,
of like we were talking about last week, go ahead. I'm sorry. Go
no,
ahead.
you go ahead. Go ahead.
I was just going to say, and kind of like we were talking about last week, at the stage that you're at now, it becomes harder and harder to identify those positions that you want to consolidate out of. And I would imagine, I'm trying my best not to take this Visa thing personally. I'm really trying. I think at some point I'll get over it and forgive you, but I know deep in my heart,
thing.
I know, I know deep in my heart that it's not because you think Visa's a bad business. It's more so just because you probably think Alphabet's going to be a better business. Am I thinking about that right?
Yeah, look, I'm looking, and I know everybody in the comments is already going to give their input of like, oh, Ari's, growth chasing and whatever. And I'm like, no. I'm building out positions that I literally just never want to get rid of. And I like, not that I want to get rid of Visa again, because it's a bad company or anything, but I am not sitting here thrilled about Visa in terms of what I see the ROI can be when I got Visa and Alphabet, and the technologies and what they're building out, and I'm really excited. And that's really one of the key things for me, is I'm really excited about Apple's future. And Visa's future is rock solid. I mean, I kind of was thinking about a couple things, right? So I built out this big United Health position, because I kicked J&J and I brought in United Health. That was kind of that big switch. And I love that move. United Health will stay. Now with Visa, and kind of how I was thinking about building structurally out these individual positions, people are not going to stop spending. Now, the vast majority of the world's credit card holders are Visa credit card holders by a ridiculous percentage. And so with people that are going to keep spending, and really what we're going to experience from time to time is what we're experiencing right now, consumer pullbacks and consumer restraints based on interest rates and the macro environment, right, and all the fear that's in the street, tariffs hitting hard, so people are going to buy now, probably buy less if tariffs really hit. We get put that whole picture together. Visa is going to ebb and flow, not by a crazy amount, but you get an Apple play where a massive swing, like right now, hits, and we're on the down, and this big future. Just today, I keep saying Apple when I mean to say Google. Just today, Google came out with their Ironwood chip to help their AI. And you just look at the future, and I'm saying with this really, and not to say that Visa's balance sheet is dirtied in any way or not healthy. It's a beautiful balance sheet, very healthy, very clean, predictability almost, because people are going to keep spending. But it's Alphabet, what they're building, and my conviction in what they're building, that's what I'm excited about. And I'd rather just be invested in the companies that I'm really excited about, because I already know that built into my S&P position, my S&P ETF, I got Visa. I have all these companies. But now out of all these companies, it's like which ones do I really have the conviction on that I just want to hold? And it's also quite entertaining for me to sit as I have been, trying to narrow down, like I just asked you, Ryne, if you had to take all the capital in your portfolio and make one big bet, where would it go? And I think when I start to think like that, and then I get in touch with some real, market makers, like this is how they operate. I don't know who, I get it. All the books in the world out there talk diversification, blah, 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 blah. But the vast majority of people that are in these high-powered seats, the Ken Griffins of the world, they're not operating off these crazy, 50 portfolio type, positions. It's all like these high conviction stocks. Bill Ackman being probably the leader of that, and George Soros and these guys. But they rose to the top because of that risk. And I just want to put a little bit more belief, I guess, in myself as an investor, but still play it safe, because again, it's hard for me to even say that because I have the S&P position and the secondary, foundational position with the tech ETF.
No, I mean it makes sense to me, man. It might not seem like you're diversified because you have less than 10 holdings if you're just looking at the holdings. But, when you consider that two of those holdings are made up of hundreds and hundreds and hundreds of stocks, well, it's like, yeah, you're pretty diversified. And like I said earlier, it paves the way for you to have less individual holdings. And some people might disagree with this, but I think it's reasonable to lean more into the holdings that you have a higher affinity for. At the end of the day, if you are a collector of assets, if you're a collector of stocks, a collector of companies, you should invest in the companies that you actually care about. If you don't care about a company, if it's not interesting to you, then probably not one that you should invest in, even if it is a fine business. There's plenty of other great businesses out there that you'll actually care about and get excited about, and those are the ones that you should own. If you're going to own individual companies. I was actually just reading about this. I'm rereading The Psychology of Money right now. And there's one chapter where Morgan Housel actually talks about exactly that. He talks about being, I'm going to paraphrase it, but it's basically being perfectly rational versus mostly reasonable. And we like to think as investors that we are perfectly rational, that we can completely remove our emotions from our decision-making process. And we like to think that we are robotic in that sense and can separate, emotion from, the objective numbers, but that's rarely ever the case. And, in every day we have to fight against our own human nature. And because we will always be humans, we'll never be completely 100% perfectly rational. And so with that said, it's good enough for us to just be like, pretty reasonable. And that would mean still owning what are great businesses or good businesses to own that you actually care for. And that's kind of the difference, owning something that's great, but you are completely objective about it, versus something that's still great, but you actually have some sort of attachment to. And most people think, well, you shouldn't have an emotional attachment to your holdings. And I understand why people say that, but I think we'd all be lying to ourselves if we didn't look at our portfolio right now and see that most of these holdings, most of these individual companies are ones that we actually care about, and that goes into the decision-making process, I think, as it should. And from my point of view, that's part of what makes investing fun, is being able to build ownership in these businesses that you actually care about.
Well, look, when I made the big, fuss about getting rid of J&J and then I Realty Income and all of these companies, I loved all of them. They were in my portfolio for a reason. I held on to them for a reason. But then I had to boot them for a reason, and so far I have no regrets. Actually, so far, every decision that I've made up until this point has boosted my portfolio. Now, I also want to make this very clear, is the only reason I am doing what I'm doing is because I can afford to do it at this point in my investing career. And if I wanted to do this in 10 to 15 years from now, it would be a totally different ball game. If I I can afford this risk.
How would it be different?
I'm kind of thinking, okay, if I look, 10 to 15 years down the road for myself and where I'd like to be, man plans and God laughs. I'll put that out there. But
yeah,
let's just say I have a little family going for myself, and I have, I don't know, life is going to present a little bit differently. My risk tolerance is going to definitely change, right? So, no, like you right now are in a position, right, just with your wife. You're in a totally different position than I am. Just with your wife alone, you have to worry about another soul in your household. Now, I got my dog, but like she's not coaching me on investing or like, asking for crazy gifts other than some, weekly bones chicken on Fridays and like when I go on vacation and I put her up in the nice doggy hotel. But that's it from her, right? So I just think right now is my opportunity. It's Ari's opportunity to play big, win big, so to speak. And I wouldn't be taking the risks that I'm taking if I had a wife or, wife and kids right now. And I know that in 10 to 15 to 20 years, my picture is going to look differently. And so right now I can afford to take the risk, which means I want everyone to understand this. I, at my core, being a dividend investor and in love with this investment approach, I'm going to loop back to building out what I will think is going to be a very beautiful dividend portfolio. But what I'm trying to do while I can right now is amass an insane amount of capital, right? Think about Warren Buffett now building up this huge, just fortress of capital. Now, if he were to deploy that capital into dividend-paying stocks, I mean, just imagine that, the passive income that's coming in from billions and billions of dollars. And I don't know, for me, I don't want to say I'm never going to get to billions. Hopefully I do, right? But the whole
you feel
point
like a billionaire
is
anyway already.
Yeah, exactly. I say that all the time, man. I'm a billionaire. So
yeah.
The whole point, though, is like, can I expedite the process for myself right now while I can afford to take this risk? It's one of those things where, they say when you're young, like in your early 20s, go do whatever the heck you want to do and get it all out of your system. Because eventually This is reality. Eventually, those things that you want to do in your early 20s, it's not so cute at 30 and 40 years old. Get that out of your system. If you want to go do some crazy, YOLOing backpack trip or whatever, it's a little harder to do that at 35 or 40 years old when you have a family, kids, and all these other things to sustain than when you're 21 or 22, and maybe you don't have a lot of money. But also think about this. It's not so cute if you're 40 years old sleeping in hostels as you travel the world, right? Like, each to their own, but like, I don't know. I've been in a hostel at 20 years old with like, a guy who's like 46, and I'm like, dude, it's a little weird, so that's all I'm saying is there's a time and a place. And right now that time and a place to be a little more risky, at least for me, is when I'm single. I have the ability to do it right now, win big, play big. I'm now working knee deep in the industry, and I see how other players in this industry are playing ball. The successful ones, I don't really care about the not so successful ones. And I like what I see. I really like what I see, and it's not this crazy approach. When I think about investing, like going all in on Alphabet, that's not really that risky to me. It's like, think about that. Someone's like, oh, I'm going to take a big risk and go all in on Alphabet. Sounds like a pretty reliable position to me. Like the company's nowhere close to dead. Amazing revenue stream. Like it just, if I were saying to you, Ryne, I'm going to go all in on this crazy penny stock, I'd hope you'd say like, whoa, come on, this guy's a little nutty. But when I'm concentrating my portfolio with the backbone of the S&P, a tech ETF, and then I'm really concentrated in, say, like Apple, United Health, Google, it's like, come on, is it really that crazy? In my mind, no.
Well, you could make the argument that it's potentially even less risky because you're putting more money into a business that you may possibly understand better, and just for the mere fact that you understand it at a deeper level, that makes it inherently less risky.
Yeah. Touche.
Yeah.
That's actually a really
so
solid
I understand.
point.
I totally understand where you're coming from, man. Totally. On a similar note, talking about all this makes me wonder, would you want to be as concentrated as as the direction you're heading? Would you continue going down this direction if you didn't have the ETFs? Like, I guess put a different way, let's say that you didn't have the S&P, you didn't have your tech fund, you didn't have any ETFs. Let's just say it was individual companies. Is there a certain number that comes to mind for the amount of companies you would feel comfortable owning? Like, would it be less than 10 still? Would it be more than 10, less than 20? How would that change things for you?
Such a phenomenal question. If I didn't have the backbone of the S&P or, the two ETFs I have, absolutely not would I be doing what I'm doing. That's for me a little too much risk. Maybe ask me in a couple months.
Yeah.
No, I would still stick with the Bill Ackman approach of 7 to 10 because when people think diversification, what first comes to mind is like loading up a portfolio with 30, 40 stocks. Therefore, you're diversified because you got a little bit of everything. In my mind, what diversification means is spreading yourself across industry verticals, but still concentrating yourself in high-quality companies. And I have my golden rule of thumb, which is at any given time, there's really only a handful of high-quality companies out there. And so when you think about even the Mag 7, they're all in a little bit different of a round. Like, not all of these companies are producing all their revenue off of advertising, right? We know that to be Alphabet or Meta, right? And then you have Apple, that's more hardware. Then you have Microsoft, that's more software. Then you have Nvidia, that's chips, Amazon, e-commerce, and also AWS, right? So you start to think like even if you just diversified across the Mag 7, you're touching a little bit. Of course, they're all tech plays, but they don't all do the same thing. And I think that's what's important for people to realize. It's not like, someone's just investing into Visa, MasterCard, and American Express. All doing the same thing. And so therefore, when the economy gets a rough going, these three companies collectively fall together. No, right? So I have in the portfolio, for example, United Health is a position that I really, love, and I'm really happy I made that decision when I did. But that's my big healthcare play. And you know what? There are certain things in the United States that I don't really foresee changing for a long time, if at ever. And one of those things that I don't foresee changing is I don't see the government taking, over the healthcare, and, it's going to be private. That's what I think it will remain as in the United States. It's big, big money. And whether we like it or we don't like it, I mean, good luck to anyone who tries to go against it. So United Health, I absolutely love. And talk about another clean balance sheet, a solid dividend over, I think, 1.2%, which isn't crazy high, but it's growing on average by, I think, about 17. I think the last I saw it, 17.4% on average per year over the last 10 years. Not too shabby. And Visa's right up there too. I think the average growth rate of the dividend was like 16%, something like that. But again, I kind of look at, okay, Visa and United Health are almost one of the same to me in terms of like the padded protection that I was looking for. They have clean balance sheets. They're raking in, cash, good revenue flows. And I'm just saying to myself, well, which one do I have more conviction in? And can I chop one of these out to put them in a stock that I have more conviction in or more excited about? And Visa is that company. That I love it. It's a great company. It made its way into my portfolio, and it's made its way into the top 10, top 7, and it's remained all this time. So I love the stock. I wouldn't recommend anybody just getting rid of it because Ari Gutman's getting rid of it. I'm just here to say that in this game of concentration, which one's going to go? And it's really hard. And this is, we've been talking about this for a while, last couple of weeks. But again, I do want to circle back to your question and just say that, no, I would not be, doing this whole thing if I didn't have my ETFs, because those ETFs give me all the confidence in the world to go heavier in some of these individual stocks.
Yeah.
Ryan, I'm waiting for the
well,
day,
at the end of the day, man, it's
like heavy on this growth stuff. Like I'm waiting for the day we jump on. You're like, Ari, I sold all of my positions and I went all in on Alphabet.
well, man, don't hold your breath too long for that one. If anything, I feel a bit more reassured in my approach with all of the craziness that we've seen going on. Just having my portfolio see a considerably lower drawdown than the rest of the market, for me, is a good reminder of one of the strengths of having this all-weather strategy that I've been trying to build. I feel so good knowing that I haven't lost as much money as other things, and to me, that brings me more comfort and reassurance than would seeing my portfolio see more gains than the rest of the market, which has happened in the past on the upside. But I get more satisfaction out of seeing less drawdown on the downside. And I think, like I said, it's kind of reiterated why I'm doing this, and it's reminded me like why I optimize for this, because to me it just feels better. I don't have to claw my way back up nearly as much as others might because I haven't lost nearly as much money. I mean, I'm down in the red, but it may be like, especially after today, it may only be like, I don't know, 2% for the year in the red. So it's like I'm still hanging on there really strong, and that's been really cool to see. It's kind of playing out exactly the same way that it did back in 2022. So we'll see where it goes from here. But so far, like I said, it's been it's definitely reinforced my satisfaction with this strategy.
You know what? It's cool to see your portfolio, when you're posting out on Instagram, and you've built out a great portfolio, man. I mean, you really have. It's withstood a lot. And I think every investor should
Thank you,
take
man.
note of that, and I'm, in terms of my portfolio, like I said, I don't recommend my approach unless somebody can really handle the market storms, because when the storms come, they come. And, when I look, Ryan, at your portfolio and, how strong you've been standing so far, I'm like, damn, he's built a great portfolio. It doesn't change my mind on how I've structurally built mine out, for
Yeah.
long-term conviction and growth. And I think what's cool for all the viewers out there, and because sometimes we get this in the comments, like people are like, oh, like we're such different investors. At our core, I think we're very similar, but we're just taking at this point in time different approaches to this whole thing. And I think it will actually be pretty interesting for the viewers out there over time, if you're really tracking my portfolio and Ryan's portfolio, to see how we do and to see what it looks like over time. Because, man, I remember like a year ago, we were much closer in terms of the value of the portfolios. And then all of a sudden, I started this, concentration deal, and my portfolio took off, which was really exciting. But then we get this storm, right? And I'm like, boom, I'm knocked down, and you're going strong right now. So I just think if anything, it will be really interesting for the viewers out there to just watch and kind of see which strategy or which investment approach may work best for you.
Yeah, it's certainly a trade-off, and you have to make the decision on which one you are more comfortable with, for sure. hmm
Yeah,
As
I'd
I like
love
to
to
say,
know.
more than one way to skin the cat.
Yeah, classic. I'd love to know which way everybody out there is skinning the cat that's in front of them. How you're leaning
Yeah,
right now, it'd be very interesting to see kind of the viewership that's out there. If you're more growth oriented, because both Ryan and I really had, and I'm going to say like Ryan definitely has 100% of the dividend investing channel, and mine's been dividend investing, dividend growth investing, and I live growth investing. So I'm just really curious to see in terms of viewership who's out there and how you're investing. Are you more growth oriented? Are you dividend oriented? Are you a mixture? Are you ETFs? Let Ryan and I know. And certainly continue to drop a lot of these questions in there, because we're always trying to chop away at some of those questions that you guys all have.
yeah, absolutely, man. I think that's a good place to wrap it up. You want to send us into the end zone?
Oh, yeah. I think investors were really just getting started in terms of an interesting couple of weeks ahead of us, maybe even a few months now that we got a 90-day pause. But mark my words, I think we will get more volatility to come when the pause is nearing the play button, if you will, and we'll see how the world reacts. I think we're going to get a lot of reaction still out of news with Trump going head to head with China. So we'll have to really just keep our eyes on the market, but most importantly, don't panic. And with that, you can keep all your calm by just tuning in with Ryan and I here on the deep end, talking things out, taking a breather, getting your mind off the market. And with that, Ryan and I look forward to seeing everybody here next week.